In most accounts, Europe went to war in August 1914 because an archduke was murdered, alliances activated, and armies began moving according to plans written years before. All of that matter had to solve timetables barely acknowledged. They had to keep banks open, pay soldiers, purchase horses, move trains, ensure ships import food, and place of shells no peacetime treasury had imagined. The First Battle of the First World War was therefore not fought only on a frontier. It was fought inside central banks and finance ministries, where officials discovered that the monetary system supporting Europe's prosperity could not support Europe's mobilization. The gold standard had promised discipline, stability, and confidence. Total war demanded credit, speed, and spending without an obvious limit. One of those systems would have to give way. To understand why, we have to return to the Europe that existed before the troop trains began moving. On the eve of war, much of the international economy rested on currencies linked to gold. A pound, mark, or franc was connected through a fixed gold value in a network of banks and exchanges to payments made across continents. An importer in one country could buy goods from another because merchants trusted the paper claims passing through London, Paris, Berlin, and other financial centers. Gold did not travel behind every commercial transaction. Most trade depended on credit, but the promise that paper could ultimately be converted into gold gave that credit its authority. The system worked because governments and central banks accepted limits on how freely they could create money. At the center of this network stood London. The British Empire supplied shipping routes, ports, insurance, and political reach. But the City of London supplied something just as important: a market where global obligations could be settled. Bills denominated in sterling financed cargoes that might never touch Britain. British banks accepted claims issued abroad. Investors purchased foreign railway bonds, municipal loans, and sovereign debt. Paris was another immense reservoir of savings. Berlin's universal banks connected industry, securities, and long-term investment. The system looked international, but access to credit still depended on confidence, reputation, and the willingness of financial institutions to continue lending. In peaceful conditions, those relationships made Europe richer. In a diplomatic crisis, they meant that fear could cross borders faster than armies. The gold standard also placed central banks inside a dangerous contradiction. If frightened investors demanded gold, a central bank was supposed to defend its reserves by raising interest rates and restricting credit. That protected the currency, but it could force banks and businesses into failure. If the central bank instead supplied emergency money, it might save the financial system while weakening confidence in gold convertibility. In ordinary crises, officials tried to balance the two responsibilities. War made the balance almost impossible. Governments needed credit to expand at precisely the moment private lenders wanted safety. Depositors wanted cash, while treasuries wanted loans. Merchants needed foreign exchange, while shipping routes were being disrupted. The rules of monetary discipline pointed toward contraction. The requirements of mobilization pointed toward expansion. Financial orthodoxy said, protect the currency. National survival said, create whatever purchasing power the state required. Some pre-war writers had already sensed the contradiction, although not always in the way later generations remembered them. Norman Angel's argument was not simply that war could never happen. It was that conquest in a financially interdependent world would not deliver the clean economic rewards imagined by nationalists. Industry, credit, and trade had become too entangled. A victor could destroy the networks from which it expected to profit. That warning was perceptive, but it underestimated the ability of states to suspend normal economic rules. European governments entered the war because they expected it to be short, because strategic fears outweighed economic caution, and because they assumed financial improvisation could bridge the distance between mobilization and victory. Then the crisis arrived. Exchanges closed. Payments were delayed. Bankers worried that obligations denominated in foreign currencies could not be settled. Individuals and firms sought cash, gold, or the safest securities available. Governments imposed moratoria, restricted withdrawals, guaranteed certain claims, and created emergency forms of liquidity. Germany suspended the redemption of banknotes into gold at the end of July 1914, effectively ending the mark's pre-war gold parity. France suspended convertibility in early August. Britain preserved the formal appearance of gold more carefully, but normal redemption and international gold movements no longer operated as they had in peacetime. The important point is not that every belligerent took the same legal step. They did not. The important point is that every major power placed the survival of its banking system and the financing of mobilization above the ordinary discipline of the pre-war monetary order. The first wartime expenditures were immediate and physical. Soldiers needed pay, their families needed allowances. Railways had to be compensated for military transport. Governments purchased grain uniforms, boots fodder, coal rifles, medical supplies, and millions of ordinary objects. These purchases could not wait for a new tax system to be designed and collected. Treasuries therefore relied on short-term instruments, bills advances, and credit supplied through banks and central banks. In Britain, the government used ways and means advances and treasury bills before launching its first major war loan. When the first wartime budget was presented in November 1914, it projected a deficit of roughly £340 million on the assumption that fighting would continue only until the end of the following March. New taxes were expected to close only a small fraction of that gap. That figure exposed the central illusion of 1914. Europe's governments had prepared military plans for mass mobilization, but they had not prepared politically acceptable methods for paying the full cost through current taxation. Taxes were visible. They reduced disposable income immediately. They could divide workers from employers, landowners from industrialists, and rich households from poor ones at the very moment governments demanded national unity. Borrowing seemed less disruptive. It allowed the state to obtain resources now while postponing the argument over who would ultimately surrender the income required for repayment. A bond transformed sacrifice into an investment. Instead of taking money openly, the government offered interest security and a patriotic certificate. Yet the accounting language concealed the deeper reality. A country could postpone payment in money. It could not postpone the need for steel, bread, coal, labor, and transport. Britain's first war loan, opened in November 1914, illustrated how difficult it was to turn national wealth into immediate government purchasing power. Britain was one of the richest financial powers on earth, but wealth scattered through property businesses, overseas investments, and private securities was not the same as cash available to the Treasury. The loan offered a government promise in exchange for funds, and the machinery for processing subscriptions strained institutions designed for far smaller issues. The campaign also revealed a problem that would haunt every belligerent if a loan appeared unsuccessful. The damage was not merely financial. It could suggest that citizens doubted victory, that banks lacked liquidity, or that government credit was weakening. War loans, therefore, had to be managed not only as transactions, but as public demonstrations of confidence. Germany constructed a parallel system around treasury bills, the Reichsbank special loan institutions, commercial banks, and repeated public war loans. The popular image of German finance as nothing more than uncontrolled printing misses the early structure of the policy. Short-term debt financed expenditure between major loan campaigns. Banks helped subscribers acquire the longer-term bonds, and the state attempted to draw private savings into its accounts. This worked well enough to sustain the war effort and to attract broad participation. But the system contained a circular risk. If banks financed bond purchases with credit, and if the central bank supported the banks against government paper, the apparent transfer of existing savings could also expand the money supply. The state was borrowing from the public, yet the banking system was helping create the means with which the public lent. France relied on its own combination of monetary support, short-term defense bonds, and a population with a long-established habit of holding financial savings. The Banque de France advanced funds to the government after convertibility was suspended, while patriotic marketing encouraged citizens to treat state debt as a defense of the nation itself. But France entered the conflict under a severe material disadvantage. Important industrial and mining regions in the north and east were occupied or threatened. The French state therefore had to finance war while part of the productive base that might have supplied taxes, coal, and manufactured goods was under enemy control. A balance sheet could record new francs and new obligations. It could not reopen an occupied mine or restore a captured factory. Finance mattered because it determined whether France could obtain replacement resources elsewhere. Russia faced an even harsher version of the same distinction between money and capacity. The imperial government could issue paper borrow and direct credit, but financial claims did not automatically repair weak transport networks or move grain efficiently from producing regions to cities and armies. The state also damaged its own revenue position when wartime prohibition sharply reduced income connected to the government's alcohol monopoly. As expenditure rose, paper money and debt expanded into an economy already strained by administrative weakness and logistical failure. This did not make revolution inevitable, and inflation alone did not destroy the empire. But it widened the gap between official financial promises and daily experience. A ruble paid to a soldier's family mattered less when goods were scarce, transport was failing, and prices were rising. By 1915, war finance had entered the household. Posters, newspapers, banks, employers, and public ceremonies told citizens that lending to the state was another form of military service. A middle-class family might take savings accumulated for retirement, education, or security and exchange them for a government bond. The certificate offered interest and the authority of the nation. It also transferred immediate purchasing power from the household to the war machine. At the same time, prices for food, fuel, and basic goods began to rise. The family could therefore pay twice, once by lending its savings and again when the money that remained purchased less. For households living on wages or fixed incomes, the sacrifice was more direct. They might own few bonds, yet still bear the inflation created by the expanding competition between military demand and civilian supply. The emergency measures of August 1914 had worked. Banks did not collapse across Europe in a single chain reaction. Governments paid their armies, factories expanded, and the first loan campaigns converted private wealth into state credit. In that limited sense, the abandonment of peacetime restraint was a remarkable institutional success, but it solved the first problem by creating a larger one. The war was lasting beyond every early financial forecast. Artillery consumed ammunition on a scale that shocked planners. Armies required continuous replacement transport food and equipment. Imports demanded shipping and foreign exchange, not merely domestic banknotes. Europe had prevented financial panic from stopping the war. It had done so by building a system that could continue only through larger debts, deeper monetary intervention, and an expanding claim on the future. The gold standard had not financed total war. Its suspension had opened the door. A shell leaving a factory represented more than steel, explosives, and labor. It represented a chain of promises. The government promised to pay the manufacturer. A bank promised to honor the manufacturer's account. Investors promised to lend their savings to the government. The central bank promised to support the banking system if those promises came under pressure. By 1915, this chain had become as essential to the battlefield as the railway lines carrying ammunition to the front. Emergency finance had prevented the first panic from stopping the war. Now the belligerents had to build something more permanent, a system capable of producing payments every day on a scale no European state had previously attempted, without exhausting public confidence or admitting that the full cost could never be collected immediately. There were only three broad ways to obtain the purchasing power required for war. A government could tax it from the population, borrow it from savers, or create it through the banking and monetary system. In practice, every major belligerent used all three. The political question was how to divide the burden. Taxation transferred resources openly and immediately. Borrowing allowed the government to spend now while promising interest and repayment later. Monetary expansion placed new purchasing power into circulation, but it risked forcing civilians to compete with the state for a limited supply of goods. The labels looked separate in a budget. In the economy, they constantly overlapped. A bond purchased with a bank loan was both government borrowing and credit creation. Interest paid to a bondholder would eventually require taxation, further borrowing, or depreciated money. The method chosen did not remove the cost. It determined when the cost appeared and who was least able to avoid it. British officials gradually accepted that taxation had to rise, although taxes never came close to covering the entire war effort. In 1915, Chancellor of the Exchequer, Reginald McKenna increased income tax, lowered the level at which people became liable, introduced selective import duties, and created the excess profits duty. The new tax answered a political as well as a fiscal need. Workers were being asked to accept long hours, military discipline in factories, rising prices, and the loss of family members. Reports of manufacturers earning extraordinary profits threatened the language of shared sacrifice. Taxing excess profits allowed the government to claim that industrial gain would not remain entirely private. Yet the state also needed those same firms to expand production, invest in machinery, and deliver weapons quickly. It was attempting to punish profiteering without weakening the industrial capacity on which survival depended. Borrowing, therefore, remained indispensable. British war finance moved through large public loans, treasury bills, exchequer bonds, savings certificates, commercial banks, insurance companies, and institutional investors. Each new security was designed to reach a different pool of money. Large financial institutions could absorb substantial issues while post offices and savings campaigns brought smaller households into the system. The language surrounding these investments was deliberately moral. Buying a bond was presented as service from the home front, a civilian counterpart to enlistment. But patriotic advertising performed an economic function. It encouraged households to reduce current consumption and transfer money to the treasury. When people purchased fewer civilian goods, more labor and materials could theoretically be redirected toward the war. The bond campaign was not merely raising money. It was attempting to reorganize national demand. France drew on an exceptionally broad culture of private saving. Government obligations could be placed through banks' local networks and short-term national defense bonds that allowed households to lend without committing their money for decades. The Banque de France continued advancing funds to the state while Britain and later the United States helped protect France's ability to purchase abroad. Yet French finance could never be separated from occupation. Some of the country's most important coal iron and industrial districts were in or near the territory seized by Germany. The government was therefore mobilizing savings while simultaneously losing part of the productive capacity those savings would normally command. French citizens could lend francs to Paris, but many essential goods had to be acquired outside France. This turned foreign exchange shipping and allied cooperation into weapons of war. Germany also mobilized domestic savings on an enormous scale. 9 major war loan campaigns eventually invited citizens, banks, municipalities, businesses, and institutions to finance the imperial government. Subscription ceremonies and propaganda presented the loans as votes of confidence and victory. German households continued purchasing them even as the military situation deteriorated, evidence that the system retained social and institutional strength longer than a simple story of financial collapse would suggest. But the design was risky. Germany raised relatively little of its wartime expenditure through new taxation. Short-term treasury bills accumulated between loan campaigns. Banks helped finance subscriptions, and the Reichsbank accepted government-related paper within the credit system. Each successful loan appeared to replace short-term obligations with longer-term public debt. Yet if buyers obtained the money through bank credit, the conversion did not fully remove inflationary pressure. This was the central feedback loop of wartime borrowing. The government spent money into the economy. Contractors, workers, and suppliers deposited that money in banks. The banks and their customers then used part of those deposits to purchase government securities. The state could point to the subscriptions as proof that the public had voluntarily financed the war. But the original money had often entered circulation through state expenditure and central bank-supported credit. Government spending created deposits. Deposits purchased bonds. Bonds supported further government spending. The loop could continue as long as people trusted the currency, accepted the securities, and found enough goods to buy. Once goods became scarce and confidence weakened, the same system produced higher prices, forced saving, and growing resentment. Historians have often contrasted Britain's greater use of taxation with Germany's dependence on borrowing, and have connected that difference to the post-war condition of the two states. The comparison is useful but incomplete. Britain did develop a broader and more productive tax system. Germany's federal structure and political conflicts made direct imperial taxation more difficult. Some German officials also expected victory to bring indemnities or territorial gains that would ease the final burden. Nevertheless, neither country paid for the war principally from current revenue. Both relied heavily on debt banks and monetary accommodation. The larger difference was not simply that one government behaved responsibly while the other printed recklessly. Britain could combine domestic finance with access to an empire oceanic trade, foreign investments, and eventually the American capital market. Germany increasingly had to finance a global conflict inside a blockaded continental system. A domestic bond could command labor and goods within the country issuing it. It could not automatically purchase wheat in Argentina, copper in the United States, or machinery from a neutral exporter. Foreign suppliers wanted payment they trusted and currencies they could use. For Britain and France, the problem became acute as imports of food, petroleum metals, chemicals, vehicles, and munitions expanded. Britain could draw on overseas income, gold dollar balances, and foreign securities accumulated during decades as a creditor nation. The Treasury developed methods to encourage or compel the mobilization of privately held American securities, which could be sold or used as collateral to obtain dollars. In effect, Britain began consuming part of the international investment position built before the war. The nation was financing survival by liquidating elements of its former financial supremacy. Control of sea routes magnified this advantage. British naval power did not make Allied finance painless, but it helped connect Allied credit to the physical goods that credit was intended to purchase. Cargoes could cross the Atlantic under threat, while insurance shipping priorities and government purchasing systems directed them toward the war effort. Germany's financial isolation was reinforced by the blockade. Even a successful domestic loan could not create access to overseas markets that ships could no longer reach. The mark could circulate inside Germany, but neutral exporters had limited reason to accumulate claims they might be unable to spend, convert, or enforce. Financial strength and physical access had become inseparable. Credit mattered because it opened warehouses, loaded ships, and secured imports. When the route to those goods was closed, additional paper claims offered diminishing strategic value. The empires extended these systems far beyond Europe. Colonial governments raised taxes, controlled trade, redirected commodities, restricted local consumption, and supplied labor for transport and production. Wartime disruption reduced customs revenue in many territories, prompting administrations to increase direct taxation or impose new controls on African and Asian populations. Goods extracted from colonies did not always appear in European budgets at their full social cost. A commodity could be requisitioned at controlled prices. A railway could be diverted from civilian trade to military movement. Local development spending could be postponed while metropolitan governments claimed the available revenue in shipping. The financial history of total war, therefore, cannot be reduced to European bondholders. Part of the system rested on populations that had little influence over the decisions being financed and received no equal claim on the post-war order. Russia occupied a vulnerable position inside the Allied network. The empire could borrow abroad and received substantial British and French support, but foreign lending frequently came with demands for gold collateral purchasing controls or strategic coordination. Domestically, government borrowing and paper money expansion encountered a society in which banking access and liquid financial savings were less broadly distributed than in Britain, France, or Germany. More important, additional money could not overcome the collapse of distribution. Grain might exist in the countryside while cities experienced shortages. Railway cars might be assigned to military transport, while fuel and food accumulated elsewhere. Inflation then reflected more than excessive currency. It reflected an administrative system creating claims on goods that it could not move effectively. The ruble was weakening at the same time. The state's ability to make the ruble useful was deteriorating. For ordinary Europeans, inflation became the least explicit method of wartime payment. A tax bill announced what the government had taken. Rising prices did not. A worker might receive a higher nominal wage and still bring home less food. A pensioner or widow living on a fixed payment could watch the value of that payment shrink month after month. Bondholders earned interest, but the purchasing power of the interest depended on what happened to prices. Businesses receiving government contracts might expand, while firms dependent on civilian customers or imported materials failed. The result did not follow one simple line between rich and poor. Some wealthy savers lost heavily in real terms. Some industrial firms prospered. Some workers gained bargaining power in essential industries. But households with little property and limited ability to raise their income were usually the least protected from shortages and depreciation. By 1915, the Allies were purchasing American goods on a scale that required a more organized financial bridge. In January, J.P. Morgan and Company became the British government's purchasing agent in the United States and later served France in a comparable capacity. The firm coordinated orders, suppliers, shipping arrangements, and financial transactions across an American industrial economy, still formally outside the war. In the autumn of 1915, a syndicate headed by Morgan arranged a $500 million Anglo-French loan, then an unprecedented foreign issue in the American market. The loan did not mean that one bank controlled Allied governments or secretly dictated American policy. It meant that a private financial network had become a crucial intermediary between European states consuming resources and American firms producing them. The relationship nevertheless created political and strategic consequences. Morgan and other banks earned commissions and had an interest in Allied solvency. American manufacturers expanded to fulfill foreign contracts. Export regions benefited from European demand. Farmers, steel producers, chemical firms, railways, ports, and shipping interests became connected to the purchasing power of Britain and France. Critics warned that private credit compromised American neutrality and gave financiers a reason to favor Allied victory. That concern was not imaginary, but profit alone does not prove control or conspiracy. The imbalance also reflected geography and naval power. The Allies could reach American ports and protect much of the traffic. Germany could not participate on equal terms, while British power restricted its trade. The financial relationship was therefore both commercial and geopolitical. The Anglo-French loan bought time, not independence. Allied imports continued to rise, while gold shipments, asset sales, private loans, and sterling support operations placed increasing pressure on Britain's reserves. France depended on British assistance. Britain depended increasingly on the American market. Russia depended on both Western allies while its internal economy weakened. Alternatives still existed. Taxes could be raised further. Civilian imports could be cut. Consumption could be controlled more severely. Peace might have ended the accumulation of debt. But every alternative carried political or military danger. Higher taxes threatened unity. Reduced supplies threatened armies and cities. Negotiated peace threatened governments that had justified immense casualties through promises of victory. Each rational attempt to preserve the war effort narrowed the path back to financial normality. By early 1917, the Allied system had not found a way to pay for total war without sacrifice. It had found access to a larger reservoir of production and credit than the Central Powers could reach. American factories supplied goods that European economies could no longer produce in sufficient quantities. American banks supplied dollars when European gold and marketable assets were being depleted. Yet private credit had limits, and the Allied demand for funds was beginning to exceed what banking syndicates could safely provide. The next transformation would come when the United States ceased to be merely a neutral supplier and private creditor. Once Washington entered the conflict, the balance sheet of the American government would stand behind the flow of resources. Europe's war was about to become America's financial commitment. When the United States entered the war in April 1917, it did more than add soldiers, ships, and factories to the Allied coalition. It added the borrowing power of a government whose territory had not been devastated, whose productive capacity was expanding, and whose financial institutions were receiving gold and foreign assets from a weakening Europe. Until then, Britain and France had depended heavily on private American banks and securities markets. Now the United States Treasury could lend directly to Allied governments. Private financial exposure became intergovernmental debt. American grain, steel, oil machinery, and explosives could continue crossing the Atlantic because Washington stood behind the credits used to purchase them. The military balance shifted slowly. The financial balance shifted almost immediately. The American government still had to mobilize its own resources. The Treasury raised taxes, but it relied heavily on a sequence of Liberty loan campaigns that invited millions of Americans to buy government bonds. Banks advertised the securities, employers encouraged subscriptions, public figures spoke at rallies, and the recently established Federal Reserve helped create a financial environment in which commercial banks could lend against government obligations. The campaigns widened participation in federal finance, but they also repeated the central mechanism already visible in Europe. The state borrowed purchasing power from the public, while the banking system helped ensure that the public possessed enough credit to lend. American households received interest-bearing promises. The government received the power to purchase ships, food, weapons, and supplies immediately. This new reservoir of credit did not erase the Allies' weaknesses. It allowed them to continue despite those weaknesses. Britain remained responsible for financing and supplying parts of the coalition, even while borrowing from the United States. France fought with productive regions damaged or occupied. Italy required external assistance. Russia had already fallen into revolution. By 1917, the financial structure of the Allied war effort resembled a chain of obligations running westward. Weaker allies depended on stronger European allies. Britain and France depended increasingly on the United States. American lenders and taxpayers stood behind purchases made for battlefields thousands of miles away. Victory was not being paid for from one national treasury. It was being assembled through a hierarchy of credit. Germany could not build an equivalent external system. It continued raising domestic loans and expanding state-supported credit, but the blockade and military geography restricted access to global markets. German financial claims could mobilize labor and goods inside the territories controlled by the Central Powers. They could not freely command American wheat Chilean nitrates, overseas oil, or neutral shipping. This distinction became decisive. A government can create currency. It cannot create foreign exchange accepted by distant suppliers, and it cannot print the cargo that foreign exchange is supposed to buy. Germany's problem was therefore not simply that it borrowed too much. It was borrowing within an increasingly enclosed economy whose physical resources, civilian consumption, and political patience were being exhausted. By the final year of the war, every belligerent had narrowed the choices available to itself. Governments could not easily stop borrowing without stopping production. They could not sharply reduce military expenditure without risking defeat. They could not impose the entire burden through immediate taxation without provoking stronger opposition from workers, businesses, landowners, and the middle class. They could not protect civilian living standards while armies consumed food fuel metals, transport, and labor on an unprecedented scale. Policies that had begun as temporary improvisations had become conditions of survival. More credit produced more spending. More spending increased prices and shortages. More shortages produced controls, rationing, and resentment. The financial machinery was still functioning, but it was no longer preserving the society that had created it. Then the shooting stopped. In November 1918, crowds filled streets, flags appeared in windows, and soldiers began imagining a return to ordinary life. Inside finance ministries, however, the armistice did not look like an ending. It looked like a change in the form of the crisis. Governments possessed enormous debts, swollen bureaucracies, pension commitments, damaged tax bases and currencies whose purchasing power had already weakened. Millions of soldiers had to be demobilized and employed. Factories had to shift away from military production. Occupied and destroyed regions required reconstruction. Food supplies remained unstable. The war had ended before the financial system built to sustain it could be dismantled. Who then paid for total war? The answer depends on what payment means. Soldiers paid through death, injury, lost years, and interrupted futures. Civilians paid through hunger, overwork requisitions, and reduced consumption. Taxpayers surrendered part of their current income. Bondholders advanced savings in exchange for legal promises of interest and repayment. Colonial populations supplied taxes, commodities, transport, and labor under political systems they did not control. Businesses absorbed regulation and shortages, although some also received extraordinary contracts and profits. Future taxpayers inherited obligations created before they could vote. Currency holders paid whenever inflation reduced what their money could buy. The cost was not settled in one transaction, it was distributed across classes, territories, and generations. Inflation became one of the most powerful instruments of that distribution because it did not arrive with a tax notice. A government could repay a bond in the number of francs, marks, pounds, or lire promised while returning far less purchasing power than the lender had originally surrendered. A widow living on fixed interest might receive every scheduled payment and still become poorer. A worker might win a wage increase and discover that food prices had moved faster. A debtor could benefit as the real weight of an old obligation declined, while a cautious saver was punished for holding money. Inflation was not a perfectly designed tax, and it did not burden everyone equally. It was the social result of too much purchasing power, pursuing goods reduced by destruction, shortage controls, and military demand. Russia demonstrated that financial promises depended on political survival. The imperial government had borrowed from foreign investors and its own citizens, issued currency, and pledged future revenues to sustain the war. Revolution replaced the state that had made those promises. The Bolshevik government repudiated much of the old regime's debt, transforming securities once sold as safe obligations into symbols of a vanished political order. Foreign creditors described the action as default. Revolutionaries described it as liberation from the liabilities of empire and war. For bondholders, the ideological argument did not restore their savings. The episode exposed a fact that wartime propaganda had obscured sovereign debt is secured not by paper alone, but by the continued authority and willingness of the state that signs it. At the Paris Peace Conference, financial questions became inseparable from moral and strategic ones. France demanded security and compensation after invasion and destruction. Britain wanted Germany to pay, but also needed European trade to recover. Allied governments owed large sums to the United States and hoped that reparations might help them meet their own obligations. The United States treated Allied debts and German reparations as legally separate, but European leaders knew the payment chains were politically connected. Germany was expected to transfer resources to the victors. The victors were expected to repay America. Yet Germany could obtain foreign currency only by exporting more than it imported, borrowing abroad, or transferring assets. The settlement demanded payment while every major government also wanted to protect its own industries and employment. John Maynard Keynes, who participated in the British delegation before resigning, warned that a settlement focused on extracting payments without restoring European production and trade could deepen instability. His criticism became famous because it identified a genuine contradiction. Europe required German economic recovery if Germany was to make substantial transfers, but many Europeans feared that a recovered Germany would again become powerful. Keynes did not settle every later debate about what Germany could afford, and reparations alone did not cause every post-war crisis. But he understood that debts were not merely legal claims. They were claims on future exports, taxes, wages, and political consent. If those real resources could not be transferred, the accounting would become a source of conflict rather than reconstruction. Germany's hyperinflation in 1923 is often presented as a simple morality tale about a government printing money to pay reparations. The deeper history is more complicated. Wartime borrowing had left the state with a vast burden and a tax system unable to meet its obligations. Defeat weakened legitimacy. Revolution, political violence, territorial losses. Capital flight exchange depreciation and disputes over reparations intensified the pressure. When France and Belgium occupied the Ruhr and the German government supported passive resistance, fiscal expenditure expanded while production and revenue were disrupted. Money creation became the means of sustaining a political confrontation the state could not otherwise finance. Wartime debt prepared the weakness. Post-war decisions converted weakness into monetary collapse. The destruction of the mark did not affect all Germans in the same way. Debtors could see old obligations disappear in real terms. Owners of foreign currency commodities, land, or export businesses could protect part of their wealth. People dependent on salaries, pensions, savings accounts, or fixed interest securities often could not. A middle-class household might possess stacks of notes and government certificates while lacking the purchasing power to buy basic goods. The numerical value of money rose into absurdity as its economic meaning disappeared. The state had once persuaded citizens that buying war bonds was a patriotic investment in national victory. After defeat and inflation, many discovered that the promise had survived only as ink on paper. Britain avoided hyperinflation and emerged among the victors, but victory did not preserve its pre-war financial position. The country had sold or mobilized foreign assets, borrowed heavily, and become indebted to the United States. London remained a major financial center. Sterling remained internationally important, and Britain did not surrender global influence overnight. Yet the direction of change was unmistakable. Before 1914, Britain had often supplied capital to the world. During the war, it increasingly required American dollars to sustain itself and its allies. New York's banks, the United States Treasury, and the dollar had acquired a significance that would have seemed improbable when the European armies first mobilized. The post-war attempt to restore monetary normality could not erase what had happened. Governments wanted stable currencies and renewed trade, but they also wanted debt repayment, employment, social benefits, military security, and protection for domestic industry. These goals often conflicted. Returning to gold at an unrealistic exchange rate could require deflation, wage pressure, and unemployment. Allowing currencies to depreciate threatened savers and creditors. Canceling debts would shift losses onto lenders. Enforcing them could destabilize debtors. The pre-war gold standard had depended on political willingness to place currency stability above many domestic demands. After mass mobilization, universal sacrifice, inflation revolution, and expanded voting rights, that willingness was far harder to sustain. The conventional history of World War I correctly emphasizes Sarajevo alliances, military planning, nationalism, imperial rivalry, and the decisions of political leaders. Finance did not replace those causes. A bond did not assassinate an archduke, and a central bank did not order armies across a border. But finance explains why the conflict could grow beyond its original plans and continue after the first campaigns failed. Debt transformed future income into present firepower. Banks converted state promises into spendable credit. Inflation redirected purchasing power away from civilians. Empires transferred resources from people with little political control. American lending connected European battlefields to a larger industrial economy. The war was fought by armies, but its duration depended on institutions capable of claiming resources from people who were not in the trenches. Return to August 1914, and the image of soldiers boarding trains. The visible cargo was men, rifles, horses, and artillery. The invisible cargo was a mountain of promises. Governments promised to pay contractors. Banks promised to support governments. Citizens exchanged savings for bonds. Allies promised to reimburse one another. European states promised American creditors that future taxpayers would honor the obligations of the present. Those promises kept the trains moving long after pre-war reserves should have been exhausted. They also ensured that the armistice could end the battlefield war without ending the struggle over sacrifice. Europe paid for total war by taxing the present, borrowing from the future, weakening the value of money-consuming overseas wealth, and transferring part of its financial power across the Atlantic. The defeated paid through collapse and reparations. The victors paid through debt inflation, lost assets, and diminished independence. Ordinary families paid through prices, taxes, bereavement, and savings that no longer bought what had been promised. The gold standard had imposed limits on governments. Total war taught governments how to escape those limits. The price was a Europe that survived the war but could not restore the world that existed before it. If this documentary changed how you understand the First World War, subscribe to the Price of History docs and like the video. And tell us in the comments which mattered most in determining financial endurance: taxation, domestic borrowing, access to global trade, or American credit.